Hi, so today I want to take a look at the GFC back in 2008 and 2009 and see what we should have learnt from then. I was just at university back then, so I didn't lose any money, but obviously a lot of people did lose a lot. Learning how to prepare for a time like this will be really important. At some stage, we will get a medium-term depressed market. Not a flash crash like we saw in 2020, but like a multi-year period of terrible returns. Now, during the GFC, the market actually corrected upwards 15 times, so a lot of people would have thought it was over to only see the market fall lower than it was previously. That must have been an emotional roller coaster for all the investors out there. So I hope you stay till the end of the video where I'll summarize a couple of great strategies that we can take into the next bad investment period. Okay, let me paint this picture for you. It's December 2008, and normally Christmas would be full of gifts and family visiting. This year, well, you still gather together, but everyone is talking about the economy. Your investments have halved in value. You were once a millionaire, and now you've only got $500,000 and it's dropping lower every week. It has been a full year since you have had $1 million in your portfolio, and it doesn't look like things are going to get much better anytime soon. The news is full of bankruptcies and people unemployed waiting for food on the street. If this is the new normal, then things are pretty ugly. All your friends and family think the stock market is rigged in favor of the rich. Money in the stock market has just been a terrible investment. There is so much logic and pressure to sell everything and wait until the world is looking a bit better again. And you can't imagine your portfolio falling down to, say, $200,000. And what if it goes to nothing? You could actually lose everything. It's now a real possibility. It has fallen 50% already. There is nothing stopping the market falling another 50% or even worse. Now, this was the situation for a regular person. But what about those who worked on Wall Street in the heart of the crisis? If you still had a job, well, it would have been a miracle. So imagine the fund managers going to their office during that time. 1. In the case of Monish Pabrai or Guy Spear, you would have lost your clients tens of millions of dollars. 2. You would have angry investors demanding that you explain to them every decision you have made. 3. You would have many investors wanting their money back, well, what was left of it anyway. And 4. People that trusted you to look after their money would have just lost trust with you, and you would have lost trust with yourself. Imagine every day your friends and family wanting you to explain what you were doing to fix the situation. You would be questioning all of your investing decisions. Even if you were very confident you have money in great companies, well, now you're doubting everything you thought. Then you walk home from work, stressed from explaining to your clients that the companies you invested in are good companies, saying over and over again that they will eventually recover. Everyone just needs to be patient. But you start to doubt everything you've learned. You've lost tens of millions of dollars, 50% or more of your clients' money. Are you actually smart enough to be an investor? Did you make a huge mistake in taking other people's money? Should you just return as much as you can and close the fund down? Every day you're being tested, and on the walk home from downtown New York, you see depressed faces everywhere. You go to get a pizza with a friend, and they are panicking about their future. Your future is not looking very promising right now either. And this goes on and on. Every week it gets worse and worse, and you can't believe it can get this bad. The pressure continues to build, and the noise from everyone around you in the New York financial world is ultra depressing. The news is full of bankrupt businesses after bankrupt businesses, people losing their jobs in record amounts, no one is hiring. Every day more people are coming up to you asking for a job, like to fetch coffee or photocopy documents, anything. Then in the evening, there are more phone calls and emails from angry clients wanting you to explain certain investing moves you've made. Okay, so what I'm trying to explain is that it's easy to say that when the market falls, we will do the right thing and buy more and definitely not sell. But when the moment comes and it lasts a long time, can we really do what we say we're going to do? I don't think we can. I think most of us are going to get spooked out of the market and wait for things to improve. A year of fresh lows after fresh lows is going to be really brutal on our psychology. And strangely enough, the smarter the person you are, the more likely you're going to be affected. Now, I wasn't investing back in 2008, so I can only try to learn from the lessons of others. But I did get a little taste of it back in 2020. I know it was a flash crash of just 3 weeks, but I still learned a lot from it. Now, it didn't drag on like 2008, 2009, so my friends and family didn't sell much. It happened too quickly for them to sell anything. But what they did do is tell me their opinion on what they thought was going to happen. Some predicting it'll fall a lot more, the S&P down to 2,000 points, they would say. Others saying the market's going to crash for 2 years. So when there were companies at great prices that you would have wished for just 1 month previously, well, what did everyone do? Well, they did nothing. Everyone was saying that the market will go lower. And I kept thinking, how do they know what is going to happen? Now, I'm sure something similar happened to you and your friends and family. I can't be the only one who noticed this. I honestly had no idea what was going to happen, but I was also nervous. I felt it. I remember staying awake at night thinking about how crazy it was that the market had the worst week in history. Now, I didn't handle this very well. Hindsight, of course, is 2020. But I did make some okay moves. I had a few companies like Facebook, Google, and MasterCard that I'd been eyeing off for quite some time, and they all hit prices that I decided were good value, so I bought them. But what I didn't do was buy enough. What I was thinking to do was buy some at my first buy price, then more if the price fell another 10% and so on. Look, maybe this was an okay strategy, but my initial purchases were really weak. I mean, they were about maybe 2% of my portfolio. I had plenty of cash, but I was nervous about the future. So I was able to deploy some capital, but it wasn't anywhere near enough. So that should be counted as a mistake. Mistakes are great. I can look back on them and think about how I felt at the time and what I should have done differently. And what I should have done was have more conviction in my ideas and my research. I should have understood 20 or 30 companies really well, and when any of them got to my buy price, where I think I can get an above, say, 20% return on my investment, and have a margin of safety, well, that is when I should invest 10% of my portfolio into the idea. I had plenty of cash. Another thing I could have done was have less cash to begin with. I mean, I should have already been very close to fully invested, but I hadn't reached that point yet. Right now, I'm still not fully invested, but by the end of the year, I hope I'll be fully invested. Now, before I get into the strategies for the next GFC, for those who want the safest brokerage account that will be solid during a GFC event and give you the ability to buy shares in many different countries, I have a link to Interactive Brokers in my description where you will get a free Interactive Brokers stock for signing up and using the platform. Now, this is far better than Robinhood or anything else like that because Interactive Brokers have decades of experience, a strong balance sheet, and extremely solid trusted business. I think it's unwise to risk all your money in a startup like Robinhood or Webull or some of those new apps. I think it could be problematic and you don't need that extra risk when you're investing. They don't have the balance sheets or experience to handle a GFC-like event, but Interactive Brokers do. They also serve people in most countries throughout the world, so if you're in Germany or Japan, Spain or Ukraine, you can get an account. And I personally have an account with them. The New York environment messed up the clear thinking of many money managers during the GFC. Herd mentality is strongest when you're in a herd. Guy Speer moved to Zurich, Switzerland after the GFC to get away from the herd thinking of New York. Warren Buffett was already isolated away in Omaha, Nebraska. Chuck Yeager had set up his base in an old pub in a small town in Virginia. So New York, London, Tokyo, maybe Moscow, these are not the places you want to be in a GFC event. You want to be based far away from other people that have anything to do with the investments you are in. Your physical environment is critical to your thinking. Although you might think you are strong enough to avoid these traps, well, little by little, you become a product of your environment. I personally live in Kiev, Ukraine, and I noticed that being in a city does influence my thoughts. I get distracted easier, and I am busier than when I go back to the farm in Australia and stay with my mum and dad. I think isolating yourself is actually smart for a good investor. Maybe not completely isolated, so like a small town would be pretty good, I think, but a big major city is definitely not good for a long-term investor. So I think your physical location is critical, but so is your online location. If you are a long-term investor in cryptocurrency, well, stay off forums and Twitter. If you are into the stock market, well, again, stay off the forums and Twitter. I would even say be careful of what you watch here on YouTube. YouTube can be a minefield of bad advice and crazy market predictions from people trying to get your attention. That might sound pretty conflicting since I have a YouTube channel, but I'll try my best to stay rational for you. If I become irrational, you shouldn't watch my videos. So here are my strategies for the next GFC. 1. Don't check the market every day. This will drive you insane. The minute I am fully invested, I'm going to challenge myself to not look at the market price for an entire month. Maybe I'll start with a week and then build up to a month. I don't want to be emotionally influenced by potentially attractive investments. I have done the work on my investments. I need to give them some time to play out. If you want to do a challenge like this with me, let me know in the comments. Maybe we can support each other to not check prices for, I don't know, a week. Number 2, if I am not fully invested, which I'm not, I should have my watch list ready and updated with the companies I really want. Be ready to buy when the prices are reached. Don't think it can fall another 10%. If I'm going to get the returns I want with my margin of safety, well, that's great and that's perfect. Take the price that's on offer. Number 3, keep up with your favorite investors and what they're doing. Charlie Munger, Warren Buffett, Monish Pabrai, Guy Spear, they have gone through this stuff before. Number 4, avoid all YouTube clickbait videos, news, Twitter, and forums. It will only distract you and mess with your mind. It will be like being in New York in 2008 when everyone around you was losing their jobs. For example, right now there's so much stuff about hyperinflation, a market crash is imminent, and cryptocurrency madness. You're wasting your time on this stuff. Number 5, don't wait for this GFC-like event to happen. Just stick to your buy prices and play your own game. One day it will happen and you will get great prices. It's as simple as that. Just stay in your lane. I hope this has helped. Investing is more about psychology than anything else. And thanks for staying to the end, and I will see you in the next video.